Lovely. I think most of us are here and more people will be joining, but we are good to get started. Venkat sir, if you can do a quick
Yeah,
sound check.
hi. Am I audible?
Absolutely, very clearly. Thank you so much. So, yes, a very good evening to everybody who's joined us. More people will be joining the session gradually, but we'll get started given the time. Thank you once again for taking out your Saturday and joining us for this very exciting webinar as we are towards the end of another fantastic financial year. In today's webinar, we'll be talking about the bond market, what lessons we learned from this financial year, and what opportunities lie ahead, what and how can we make the most of the coming year in the fixed income market. And this conversation is with Venkat sir. Sir needs no introduction in particular. He's a bond market veteran, 35 plus years of experience in the bond market. And without further ado, I will get started. The flow is very simple that we have in mind. The flow will be in the way that we have a few questions that we have developed, which we'll be asking sir. And after that, we've kept it as an open forum where you can raise your hand or you can unmute yourself and you can ask questions about markets or about anything that you have to Venkat sir or to us. Lovely. Before we get started, just want to tell you everybody a little bit about BondVue. At BondVue, we are a SEBI registered online bond platform where we provide fixed income opportunities. Fixed income opportunities are primarily government bonds and corporate bonds. And we're also getting into multiple other areas of fixed income, like corporate fixed deposits and many other interesting fixed income opportunities, which we will be launching on the platform soon. You can check us out at www.bondvue.com, in which we also have an iOS and an Android app, which you can download and see. So, with that out of the way, and I forgot to do my introduction, my name is Vedant. I'm the co founder and CEO of BondVue. So, very excited to have everybody on the platform and over here. And we'll get started with the session. I don't have to mention too much about Sir, but Sir, it'll be very interesting for everybody who's joined. I don't know how much they have interacted with you at a personal level, but to actually understand what has been your journey and how did you get started in the bond market? Like today, when you look down 35 years ago, you are one of the leading veterans in the bond market. You know the market pulse at your fingertips. But what actually got you started into the bond market? Was it coincidental? Was it planned? And if you can give us a little highlight on your journey, I think that will be very interesting for all our participants here.
Hi, good evening, everyone, and thank you for joining. My journey into fixed income started at a time when bonds are not popular. Mainly, equity was in focus. But even today, I would rather say that same thing. It's equity mainly in focus, and at least I can admit that bonds, it's somewhat in the limelight for the retail investors per se. So, but what have attracted me over the period is about the depth of the bond market actually. So here you are not tracking only the bond prices up and down because people used to say bond is boring. So, but I would say that if you understand the bond market, you will be understanding the inflation, the interest rate, about the fiscal policy, about the global force, credit behavior, all in one shot. You will try to understand. So I have been in Delhi market for almost my entire career of 29 years, and maybe 4 5 years I was in Bombay. Before I shifted my residence to Coimbatore, my office is still in Bombay, but I moved out to Coimbatore. Shifted my residence actually. But if there is one thing this year has reminded us, it is this, bond market. I told you it is not about only interest rates. They are about understanding the entire economy, not only in India, the global economy. So we started the year expecting it'll be a very good rate cut. People felt that but if you put money in mutual funds, we'll make very good money in in debt market. the inflation will go, further down within the comfortable zone, and we will have a stable yields. And but unfortunately, it started well actually, but the last 6 months, if we see that, what we actually saw was very different. Unfortunately, starting from December onwards, nobody expected that the oil crisis will come up. Now oil moved above 100, global yields hardened, and the rupee is weakened. And instead of falling yields, yields are started moving up. And this is not the domestic story; it is a global one. So, to be frank, that if you want to talk about, I spent my entire career with only one company called ICICI Securities and Primary Dealership. I spent almost 3 decades there. So I started my career as a salesperson in Delhi, and I got into PSU, public sector enterprises origination. So people knows me from that period. Then I got into, slowly got into corporates, and then finally, before elevated as a senior VP in Mumbai, I become head of business development. And immediately after COVID, I have put in my papers after 31 years of service, and I resigned from that to start my own company called Rockfort Fincap. So that's all about. Yeah, thanks.
Perfect, sir. That's very interesting, sir. And just like taking pointers from what you said, we prepared this very simplistic GSEC benchmark movement over this year. So from say April 2nd, 2025, from the start of the financial year till yesterday, this has been the kind of curve movement that we've had. So we started around at a particular level and around 6.4-ish, and now we closed yesterday at around 6.93. So there has been around a 45-50 bip movement in the yield, but it's not been very straight. There's been lots of ups and downs in the movement itself. So if you can just share your thoughts on what do you think caused this movement, and how has this financial year been as compared to so many other financial years that you've been actively a part of, and what was that one thing that was very distinct that happened this year as compared to other years?
See, to be very frank, this financial is clearly is not a normal year. That everyone knows. Who are following the bond market, they will realize that this is not the normal year. And most of the people, as in big investors who are invested earlier at a lower interest rate, would have, never thought that the yield can go up so fast, and they would have burned the fingers also as such. So on that basis, if we see that we started very well, as I told in the introduction, I said that rate cut was there, and yields were somewhat falling, especially, lot of positive flows were there. See, bond market is the one, it don't wait for, the policy actions or something else. It's already understand the economy, understand the policy, what is going to come in. It expects what is going to be there from RBI policy, and it immediately reacts and settle there. So that's why if you see that when people expected that JP Morgan bond index fund is going to come to India, Bloomberg bond index fund going to come to India, all these things, the FPI, started buying, and foreign banks started buying. Everybody started piling up stocks actually. Then yields started falling from the peak of 760. It was there for 8%, the peak last year, and it settled for 10 15 days and came down to 760. And believe it, without any rate cut, just because of the positive news flows, the yields have come down to almost 6 quarter levels. So and then the rate cut has started happening and everything. So everybody was saying that now it will go to 5 half something. On that time I used to wonder that without any rate cuts, already the market has moved by 130 140 basis points. How it is going to, yields is going to go down further. So as expected that yields has not gone down further. Unfortunately, the positive news flow is got dried, and we started stable policy. But fortunately, we have a lot of liquidity. Banking system liquidity was very good in the initial first 6 months. So on that basis, mutual funds started buying heavily. So there were a lot of liquidity, and the short-term yields has fallen down along with the rate cuts. Lot of issuers, big players who borrows heavily in the market, they started issuing short tenor papers, in the large segment, because they get a very good pricing. And banks are slowed down because they have enough liquidity. So the banks have not issued any issuances the first 6 months. So overall, if you see short-term tenor bond issuances has overtaken long-term bond issuances in the last, I would say the first 10 months of the fiscal year. But after that, what has happened, everyone know this is basically a global risk. It's not a domestic risk, because in India, you know very well that growth is going in double digit, and we have the inflation is under control. Of course, we are expecting inflows to touch between 2 to 4% target tak jane ka chances tha. But the only thing, nobody, and liquidity was very, very comfortable. So everything was very good as far as domestic factors are concerned, but nobody expected that war will happen, and the commodity is the one is changes the entire world. So precisely oil. So once if oil goes beyond 100, the whole global economy goes for a toss, and India is also have to follow that. India, unfortunately, we have if you cross above 80 itself, we started having a lot of risk, and unfortunately it crossed more than 100 even today, and it's been there for over a month, and because of which our current account deficit is also getting affected. Rupee is getting all-time low, so automatically market started feeling somewhat uneasy. FPI started selling very heavily, mutual fund started selling very, very heavily, and there are no takers. People are want to become very light, so automatically the yield started jumping without any other reasons as such. Only because of the global risk, the bond market yields started jumping out.
So very interesting. And I mean, just asking everybody who joined in, we want to make this session a little bit more interactive. So we would love to hear from you. You can probably put in your answers on the chat box. According to you, how would you describe this financial year? Do you think this was a year of stability? It was volatile. It was a turning point in many ways from which perspective you saw the market, or was it very optimistic? So you can just put in your answers. It'll be great to hear from you. And we'll continue with the session as you do as well. But sir, just taking that point on what you said, and that's precisely so true that it all depends. Commodity also is such a big benchmark, and this year the war has really caused a lot of volatility in the market. And very coincidentally, sir, today is 20th March, 20th February, approximately 1 month ago, is when the first major airstrike happened. And what we try to do is we try to just index this and present it as a small chart to show what has been the movement in crude, in gold, silver, in USD, INR, and in Nifty 50 and Sensex. We already showed yields, but sir, would love to know your thoughts on this because Middle East volatility, of course, is there. That's affecting markets. We can see it. But on an economic level, we have not seen the trickle down happening as yet. Like, even though oil prices have increased and they are surging, as consumers today, we are not seeing the pinch. There may be a demand supply issue, but we're not seeing a price pinch as yet or as much as we should. So given what has happened, how do you see this impacting bond markets in the coming year? Would the impact be such that yields will keep on rising, yields will fall? What is your take on this, sir, as a longer term projection into the market?
See, definitely the entire people in India knows about that at any cost, the oil prices have to go up, because at the current level, current prices cannot sustain for a long term. So, but at the moment, government has kind enough to, cut the excise duty so that, retail customers, individuals or the residents of India may not have to bear extra cost for time being. So, but whatever amount they have done, it's very good, but that itself, it's going to eat up the fiscal deficit, and definitely, is going to sustain, then definitely the fiscal deficits all tend to shoot up also. That is one way we have to look at it. But the other way, currently, as they're done an extra duty, currently the cost of diesel or petrol is not going to go up, and they may delay it. I would say it is not going to be that, because government cannot bear all the costs, but at least the first step they have put in by cutting the excise duty. But maybe after the state elections, etc., or if the price is going to be sustained at these levels only, and even government may not have enough leg room to keep the prices stable. So at least they have to increase some prices up, maybe post elections in sometime in May. So till April, I feel that till third week of April, I feel that the prices will be stable. And after that, the prices can go up. So thereby, if the price is going up, definitely we can expect the inflation will become sticky and the yields will get further hardened. So, but however, Government of India and RBI, yesterday RBI came with the borrowing calendar, which is somewhat, everybody, the entire market somewhat have, feel comfortable the way they are listed it. And we have to look at it, what is going to be there in the RBI monetary policy. So the market directions will turn accordingly. But as of now, definitely for institutional investors is a bad time. But I would say for the retail investors, maybe this may be the good time to enter into.
It's a very interesting thought, sir. And I mean, asking our participants again, how do you think the Middle East volatility and things that are happening around that are going to affect bond yields? Are yields going to shoot up? Are they going to drop down? Are long-term or short-term rates what's going to get affected more? You can feel free and drop in your answers in the chat box that you have. And sir, because you mentioned specifically inflation and interest rates, we did see a specific type of interest rate inflation period in the current financial year. But how do you expect the coming financial year to be, sir? Are we expecting, or do you think there will be rate cuts that will be there, or will it remain stable? Or and what would inflation projections be according to your experience and understanding?
A few months back, some of the market participants have said that we may expect one more rate cut. But half of the people like me have said that rate cut scenario may not be there, at least for the time being, maybe another 6 months to 8 months. There will be a long pass because the policy also has been neutral. So we expected that, it will be a long pause, or some people rather expected there could be one more rate cut. But considering that, the inflation, as the RBI governor has said, that inflation tend to inch up a bit at that point of time. So now with the current scenario, we expect, the growth to go down, and inflation is to go up, and unemployment may increase because, for example, there was a severe gas shortage and commercial gas cylinders and everything. A lot of small time shops, MSME, everything has been struggling. So this scenario is definitely giving up, enough possibility of keeping the inflation high, and thereby definitely the yields can harden further. And in all probability, if not the next policy, definitely I would expect the August policy to be precisely, I can expect a rate hike scenario can start.
Interesting. I think all our participants also, to your previous point, they're all mentioning that how yields are going to drop. Some are saying how yields will increase to 7.25 as the ceiling. So various perspectives on the market, and let's see what the coming year holds. But sir, on your point, absolutely, would also really like to learn from our participants as to what do you think? Do you think there is going to be a rate cut this year? Is there going to be a hike? Is the RBI going to keep the rate steady, or are you not sure or want to understand more on how this works? We can probably understand more from sir.
The rate cut possibilities definitely is not going to be there. That
Right.
is ruled out definitely. So maybe for a first two policy, that means the April policy and then June policy, they may keep it, with no change as such, or maybe in the June policy they can change the stance also. But I would expect from the August policy, they can start increasing they can increasing the rates as such. So that is my expectation personally. So because of, we have to see how long the war is going to get dragged on. It all depends upon that, and how severe is going to be there. So if going to be severe enough, it's all depends upon where the oil is. Now the prime concern is that, where the oil is going to be. The first initial worry was that in India, that, whether oil is going to come in or not, and how it's going to get gases and everything. But thankfully, India has speeded up the production in India itself, and they started procuring from other countries. And thankfully, Iran has said that we may allow Indian vessels, tankers to India via Strait of Hormuz. So all these things, one thing is slightly getting eased out. There could be a possibility that we may not have a deficit, or maybe we not have a huge deficit on oil, on receipt of oil, tankers and everything, on the gases, etc. Hopefully, that things could be easing out. But definitely the concern is going to be the oil prices. So if the oil price is not going to come down, definitely it's, current account deficit can go up and rupee can already is weakened up, and the already the prices of yields, market yields have gone up. If the inflation is going to shoot up. So for example, if by May or June, if the petroleum prices goes up, and definitely we can expect definitely RBI to come hard, and they have to know that left with no other choice to increase the rates. So on that basis, definitely I would say that I'm not expecting the rates to come down sharply even if the war ends immediately. There may be a slight yield down, marginally yields can come down by maybe 5 to 10 basis points if the war ends and normalcy returns. But whatever the post effect, and again we have to see what is going to be the oil prices, because some of the countries already stop production because of the war. They have to restart. How quickly they'll become to normalcy, how quickly the prices can come down, as nobody's guess. So on that basis, immediately we are not expecting any kind of a remedy as far as the oil prices are concerned. So on that basis, I'm not expecting any major yield dropping even if the war stops. Uh, if it is we are today, it's like this. I think we are already the yields have gone up, and you can see the state development loan cutoff has come to 8 to 8.09. So definitely these things are already showing. If it's going to get worsen, definitely we can expect GSEC 10-year can move from here from 7% to 7.25.
Good. So I think, yeah, a couple of the participants have also mentioned this. In fact, Mr. Sham also mentioned that yields will be elevated and lower chances of rate cuts, as you're mentioning. So I think the participants are quite agreeing with this and sharing their thoughts. Very interesting to hear your thoughts. Please keep on sharing it as we move forward in the session. And so just taking again inspiration from your point, because these global factors are so dependent to Indian markets, we were trying to do a quick analysis to understand where does India stand today with the global bond markets. And if we take, say, few of the top economies, both developed, developing ones, and their total debt market size, their sovereign debt to GDP ratio, and their benchmark yields, we see where India kind of falls right in the middle, where we have something like Brazil, which is having a very high benchmark yield, and something like your China having a lower one. So, sir, what are your thoughts on Indian markets versus global markets, especially emerging markets? Where would India be positioned also as an opportunity in the next 2 to 3 years in this as compared to other markets?
See, what I can tell you very clearly is that our strength is, as of today, is a very good growth we are having. I think no other emerging markets is having this kind of a growth, double-digit growth currently having, or even developed economies are also not having this kind of a growth. Now we have to see how the growth is going to get be accelerated. But we have a stable banking system also. So that is second important strength, because after removing all the MPAs and measure of all the PSU banks and everything, our banking system is phenomenal now. Third thing is that our policy credibility. RBI has been, internationally, worldwide is accredited. So that absolutely there's no problem. We have been well managed and we don't have to worry. In spite of all these problems, even yesterday's, for example, SDL subscription was almost there, even though they have to pay 8%, but it was fully subscribed. And all the government of India auctions also is fully subscribed without, giving to the PDs as such. So it's not devolved on PDs as such. So those things are all very, very good strength as far as I'm concerned. But the challenge, I said again and again, it's going to be oil dependency, because India's oil import is the highest in the world. So that has to get reduced. I don't know how they, because they have to see some other alternatives how they can do it. And we have the currency vulnerability, because if you can see that how suddenly the last 3 months how the currency has been weakened and is all-time low currently. Third thing is that everyone knows that the highest borrowing currently we are having, even though we can say that net borrowing is almost 20,000 crore extra, but the gross borrowing is very high. Not only central government, it is going to be the state government borrowing is also. So if we combine together, because the last year, last few years, if we see state government borrowing used to be slightly less in the first 6 months, and they used to speed up the second 6 month, or especially the last quarter. The first beginning of the months, it'll be very, very modest. But now, the last year, if you see, they have started borrowing from the April month itself. So that has created, and especially the basic problem for government of India and the state government is that they have started borrowing heavily on the ultra long tenors. So that has pushed the yields up. That's how it's all started actually. This is whatever has happened now, the war, etc. is unfortunate, but the yields have started going up because of, too much supply on the ultra long tenors. So on that basis, we have some issues, but other than that, our internal domestic system is strong enough to meet all these challenges. And definitely, as of today, what we are seeing current volatility is basically, as I told you, is more of a global risk than domestic factors.
So that's actually very interesting. Like if you look at it and compare to other developing economies, as you rightly pointed out, our policy and our banking system is so strong and so like getting matured and so adaptable as well that we are seeing how we're able to flourish as an economy over time with the GDP, etc., growing. And I think that's why it's a great space in a country to be at this point of time, given the current yield scenario and even the macroeconomic factors globally that we are seeing, right? So that's lovely to hear, sir. So just taking this now one step below and trying to actually understand that we spoke about macros, we spoke about global markets. How does this actually affect us as investors? And where can we see opportunities in the market? We'll try to shift the focus of the webinar to that because a few questions from the participants have also been around that. As to so, what are the biggest opportunities that you see in the bond market in India in the next 2 to 3 years? Please, sir.
See, I would say if it is going to be the retail investors and the opportunities are already there. Yesterday, you would have seen that state development loans is giving 8.09 semi-annual. Okay, the highest yield, highest tenor actually. Even for a 10-year tenor, it would have been there, could have been somewhere around 770, 770 semi-annual. So currently, if we see that, the FDs as such, as I said, that bond market reacts very quickly without waiting for any policy reactions or government reactions. But the banks have to wait for the policy reactions. The policy, whether they're doing a rate cut or a rate hike, and slowly, if it is a rate cut, quickly they'll cut the rates. If it is a rate hike, they'll be very slow in reacting. So on that basis, they are not going to increase the yields immediately. Be very clear on that. So on that basis, now even senior citizens per se, people who want retired income on a monthly income, etc., they are also sort of looking for other alternatives. Of course, the risk of bank FDs is minimized now because many people, I'm sure, aware of it. Even bank FDs are all unsecured. In case if the bank defaults are shutting down and you're not going to get any money, except that government has said DIGJIC will give you 5 lakhs for the retail investors, and for senior citizen they'll give the entire amount. But that risk is always there. However, if you next in line, if you see that if you have this small savings where you give between 690 to 820 kind of a range, but of course, these are all long term. It is not as liquid as a FD. So definitely, whatever you say, you call it anything, FD is the most liquid instrument in India. At any point of time, even if you pay some penalty, you can get out. That thing is always been there. But the end of the day, the bond market currently, the kind of you know uh, yield or coupon interest rate it is offering, and it is going to offer in the next 2 to 3 years, is going to be exciting for the retail investors. So retail investors, already should keep their watch how the market is behaving and what are all things they have to look into, and what could be the rate expectations and what kind of instruments you want to get into, whether you want to get into the safer mode of government securities, or that's why I said state government securities is next to sovereign bond only. So it's almost sovereign bond only is zero interest risk only. That itself is offering around 8 to 8.09 semi-annual, which is you're not going to get it anywhere as such, and it's going to be half yearly payments. So on that basis, then it comes to corporate bonds. So you have to be very, very selective on which corporate bond you want to get into, what type of corporate bonds you want to get into. So those things we'll talk about in the subsequent questions maybe. But definitely, this is going to be the exciting year for the retail investors the coming years.
So very interesting. So of course, SDLs are have actually touched a very high yield estate, great space to be, and as you mentioned, corporate bonds as well. And so that gets me to the follow-up question that I have with you, because when we look at opportunities, we also look at risks and challenges. That, sir, according to you, been a veteran for 35 years in the bond market, and given the current scenario, what is the biggest challenge or a so-called myth, if you can call it, in the bond market, and how can it be tackled, sir?
See, myth is said that people will be thinking that I said initially itself, I said that, bond market is boring and, bond market may kuch, exciting nahi hai. Now you would have seen this year how the market has behaved. In one day, people have lost money and, the yields have gone up and everything. So, it is bond market is too risky because that's why I'm keep on telling, you cannot think that bond market is the safest instrument. I would always say that it all depends upon what kind of instruments you are getting into. That is the most critical thing. So people have taken risk in equity, so they understand risk very well. Even a small common man, they know what is a share market. Of course, they don't understand equity market. Both are same, but most of people understand share market. They enter into share market. They understand the risk and they know that the money can go. So if you want to fixed income, then automatically people think that okay, then if you want to get into bond market, that means it's the safest. I'll get a fixed return every month or every year or whatever it is. That shouldn't be any problem. It is not always like that. It depends upon bond market is offering a basket of instruments where it is the safest instruments to risky instruments. So it depends upon risk reward. What type of risk you want to take, what type of a coupon you want, it's all depends upon that. If you want a lowest coupon, you say that I would like to get into government of India securities equivalent to government of India, FD rates, then you can get into all this, GSEC and everything. Sometime it's currently it's offering almost 7% for a 10-year, or you can get into state government securities, etc. Thereby, but definitely if you get into his retail, etc. See, one thing people should understand, even FDs, okay, or even today in a mutual fund investment, if you want to get out, you will have a loss, you will incur losses only because the total value NAV would have come down drastically. So you can't take out the money, you'll make losses. In bond market too, is that you will not make a loss unless until you sell it. So you will continue to receive the interest till the redemption. Definitely, as a retail investors, you are getting into, I can tell you very clearly, the liquidity is not as much as the way you feel of FDs or the way you feel of equity, where you can get out, even if at a loss, you can get out. Definitely, these are all listed instruments offered by online bot portal for retail investors. You can invest in variety of bonds, starting from government securities to AAA securities, AA securities, and A kind of securities, and everything. Depends upon the yield you want or the interest rates you want. But definitely, you need to think about that for how much period you want to invest. If you want emergency fund, you keep it aside. You feel that I don't want this money for next 2 years, then you can come and put it this money, definitely into bond markets. Absolutely, there is no problem on that. So that you have to plan. So basically, here you are going to see that what I'm clearly telling is that bonds are not risk free. Interest rate and credit risk are matters. You need to understand where you are entering into, and basically most of the investors misunderstood about bond markets rather than boring.
So very interesting. So in fact, I have a personal follow-up question on this. So, sir, is it right to say when an investor is entering into the bond market, and it also takes me to the next question, they should look at bond as an asset that they need to hold till maturity and not sell, or for a newbie who's just starting out? I think a couple of our participants have also asked the question, like, what should my mindset be, or what should I look at, or what are things that I should avoid so that I walk in with that mindset? I don't walk into the bond market expecting liquidity when I know there is a liquidity crunch. What are things I should look at or avoid in that perspective, if you can help us, sir?
See, for retail investors, I would like to break this into three different categories. Okay, I'll go slowly one by one. Is that the first category is that you should know to whom you are lending your money. That means where you are investing, because lending means even FD, you are lending into a bank net. So I talk on an institutional basis. You should know whom you are giving the money to, which company you are giving the money to. So whom you are giving the money to, and for how long, what is the tenor you are giving into. Okay. Third thing is that at what kind of a return you are getting into. So this is the first category. These three questions: whom you are lending it to, what is the tenor, how long you are giving the money to, and for which how much interest you are getting. These slips into one category. Second category, you should focus on the credit quality, whether it is sovereign or it is government guaranteed or it is state government or it is triple A rated, or is a double A rated, or is a A rated, or is a triple E rated, everything. So each and every notch down from sovereign, then triple A, then double A, then A and triple B, the rates keep on increasing. Okay. So that you have to focus on. Third thing, most of the people will be like to know that liquidity. Liquidity is the problem, definitely. Till now, the retail investment segment is just started. People should understand that. So liquidity is going to be a problem for some time. So people who want to invest in bond market have to have a clear mind. Suppose if you want, I want to keep this money for only 18 months, you have some instrument available for 18 months. If you want for 2 years, you have some instrument available for 2 years. You have for 3 years, you have some instruments available for 3 years. Same way for 5 years, 10 years, and even zero coupon. Interest also, you will be getting it at say monthly interest payments, principal interest payments every month or every quarterly. That kind of options also available. And you have half yearly payments, like government of India itself is paying you half yearly payments, or you can get quarterly payments, or generally AAA bonds, etc., they pay annual interest and the principal at the end of the redemption. So you need to understand where you want to put. Duration is a very, very important thing. In liquidity, I told you, you have to be very, very specific, and you should know that even though the exit gate is available with you, exit gate is restricted for people. Matlab, unless until the market has to be good, and at what level you can sell, etc., it's going to be a very big issue for retail investors, because you should understand bond market, it started for institutional investors, and the interbank lot is only 5 crores. So if anybody state 5 crores, the exit option is somewhat liquid. But once you come down from 5 crores to 1 lakh or 2 lakh or even 10,000, then you can understand that they have to break the lot. Unless until they have some other investor is coming to buy your bond, it's going to be very difficult for liquidating your bond immediately. So accordingly, you have to look into it. So this is the second category. Third category, I want to tell you to clearly avoid is that don't chase the yields. See where is the risk. That's why I'm telling you how much risk is there, for which how much yield you can get. Don't chase the yields blindly, and don't ignore the risk. Try to understand who are the promoters, whether they have enough experience in that particular field, for how many years they have been there, what is the profitability of the company, how consistent the credit ratings are. All there are many things to look. You have 4 5 at least minimum 6 7 pointers you need to keep watching on that. Based on that, I'm very sure that your financial advisor should be able to help you where to invest. And you need to be, don't get, if you get a bank FD say at 7%, you can think about a 9% or 10%. So you'll get a very good safe instrument. If you want 14%, then that kind of a risk you have to take. You have to be very clear that where you are getting into. So be very, very clear on that. So, so locking money is another important option here. Locking money, you should not invest unless until you understand the exit options. So don't invest unless until you know the exit options, or if you have to be prepared to keep the money or keep the paper bond with you till its maturity. That is a very, very, very important thing. So these are the three things I want to tell you. Accordingly, you can go ahead and invest. Yeah, thank you.
So very interesting. I think you've summarized a retail investor's experience in these three pointers, to what to look at and what not to look at. And I think that gives a lot of clarity to me as well, someone who's also trying to understand the retail market as to what the mindset should be. Just taking a minute here to answer a quick question that has been coming up on the group chats, that if there's any course which can teach about fixed income markets. We're very happy to share that with BondVue, we have a certification course which we have recently launched, one of the only fixed income certification courses specifically about bond markets in India. I'm taking the liberty to just share the link on our chat. So, Mr. Raman and a few others were asking questions, Mr. Sarvesh. Just shared it for your reference where you can have a look at it at your time. And I'll go on to a quick one or two questions more that we had lined up. And this actually circles back to us as OBPs, sir, because you have seen the market grow so maturedly with, say, one aspect being your, say, satellite dealership, then WDM, DCM, etc. happening, and now OBPs, which are online bond platforms. How do you think, sir, OBPs over the last 3 years or 3 to 5 years have helped increase access and transparency for bonds in India? And BondView, we ourselves are an OBP trying to do this. So just wanted your thoughts on that so that retail investors can actually understand the use and the advantages of online bond platforms that are growing.
See, when I quit ISEC PD, so my mindset was to start an online bond portal. So, when we met last time also, we discussed on that also. So on that basis, at that time, I was not able to decide very frankly because I felt that the OBPs are not regulated properly. So I got into my own institutional syndication and other things. But however, later period, people have themselves realized the problem, and then the OBPs of themselves gone into SEBI, and they requested SEBI to regulate them. Since that day, OBPs has been regulated by SEBI, and they have been issuing only SEBI regulator or NSE regulator, BSE regulated listed bonds only. So these are all listed. So on that basis, if anything happens, the regulator comes to the rescue. If it is unlisted, SEBI clearly said that they are not there for any unlisted instrument in case any investor faces any issue. So one thing I can tell you is that any listed bonds, and I'm telling you, any online bond portal is allowed to issue only listed bonds. You should know very, very clearly. And second thing is that all the instruments what they are offering is, you can easily buy. Be very, very clear. You can easily buy. The online portals helps you to buy immediately at whatever the negotiated price or a price, and then you can get it dematted immediately. So this is very, very clear. So on that basis, there is absolutely no problem. You should be able to see the various papers offered by them, and you can see depending upon the credit rating and depending upon the papers offered, because in a same credit rating the coupon can differ. People should understand that also. You should know which credit rating the issuer has. That is also becoming very, very important nowadays. And accordingly, the coupon can change depending upon the credit rating agency also. So people need to understand. That's why I said very clearly, you should know the risk and what kind of paper you are getting into. So this is very, very clear. Only problem you will be facing is that I told you about the exit options. I think NSDL is working on that too, and most likely they will be coming with very soon the platform where you can exit very quickly also. Let us hope that that also comes in the coming year.
Definitely, sir. I think, as you rightly said, NSDL is working on this, and we are also working very closely as a member association to see how we can provide better liquidity avenues for investors. And OBPs in this matter have played a major role because trading volume and hence liquidity through these platforms or just access in general has increased a lot. And so that brings me to my last question, sir, to before we open the forum for questions. And a lot of participants have already put in questions, which I'll just take up after this. But how do you look at bonds in your portfolio? One as a diversification of your portfolio, and number two for long-term wealth creation. Can it or can it not be?
See, definitely bond is always going to play for a long-term wealth creation. Many years back, the erstwhile Industrial Credit and Investment Corporation of India used to say ICICI, IDBI. Now they are bank. Earlier, there used to be ICI, financial institution called ICICI, IDBI, and even NABARD. Many years back, they used to, issue deep discount bonds. Okay, you pay 5,000, and after 20 years, we'll get 1 lakh. Even I have invested in those things, and my daughter has got it 1 lakh now. So, it's a definitely now that 1 lakh has no value, but at that time for a 5,000 for a 1 lakh is definitely is a greater value. So on that basis, at any point of time, I can tell you if you're getting into the right bond and getting into the right structure, definitely it's going to be a wealth creation for you. They provide stable income for you if you want, a monthly income or a half yearly income or a quarterly income or an annual income, whatever they want. I always tell people is that the bond market or a bond per se, it's like a clay. You can mold the structure the way you want. Suppose if you want interest monthly and principal monthly, and if you have a decent amount size together, and the OBP or a arranger can go to a particular issuer and say that, boss, I want this kind of a structure. If they're agreed, they can issue to you. Same thing if you want interest quarterly, principal quarterly can be structured, but most of the AAA papers are generally giving yearly interest payment, and the principal is paid the end of the redemption period. But since you are getting into slightly higher yield, that means you'll be looking at A category kind of yields where you're getting around 10% or 11% kind of a yield. There it is to start with, any new investors are getting into, to start with, better to get into 18 months to 3 year kind of a segment where you get frequent interest payments and principal payments. So that reduces your risk on a month on month basis. And also that you should be able to get a reinvestment opportunity. Currently, we expect the rates can go up the coming year. On that basis, you get a reinvestment opportunities also. These are the main thing. And other wealth creation, I can tell you, unlike equity or option, something of that type, it gives you capital production. That is the foremost important thing you should understand. No other instrument, of course, FD is there, but capital market instrument, no other instruments gives you capital production. So this you should understand. And this is somewhat, I would say, lower volatility for retail investors because you're not going to get bothered how the market is going to be. Once you are invested, I told you that liquidity is going to be a problem for you. So if you're going to be for 18 months or 2 year or 3 year, just sit idle and keep getting money. Whatever interest rate you are locked, you are going to get that kind of interest till maturity. So these are the main thing I'm looking into it. But however, you have to that, like the way I said, SDL is currently at 8%, something of that type. You can try doing that, or some corporate bonds which is safer, which is giving a higher yield, you can get into it. And your approach should be, currently the market is extremely volatile, you should be getting into staggered investing. So this month you put, for example, I used to put personally that in state government securities, for example. I see that I expect, okay, this auction the yields can go up. Whenever I personally feel that auction the yields can go up, I try to invest some money on the particular auction. So I average it out for the way. See, I don't have to say retail investors because they have been investing in equity for a very long time. They try to keep on investing to average out. Same structure, policy. You try to invest in these bonds to average the yields. Today you get say around 10%. Tomorrow you get 10 quarters. Sometimes you get 11. Sometimes you get 11, 9%. Depends upon the market movements. So staggering of investment is always good for you, and you have to be very clear that if it is a AAA or a state government securities kind of auction, you should have a long term horizon, because I told you that exit option is, as of today, is limited. But short term investment, you don't have to exit immediately because you are getting into short term instrument of 18 months to 3 years only. That is there. And you need to have a balanced allocation along with equities. So you should, that's why you need not worry, because if equity, you can see that last 1 month what has happened to equity. So you cannot expect that equities always goes up, and people get afraid when the falling markets. If they're able to get it, take at some point of time, because I have seen people was keep on re-entering as and when the market keep on falling, and every day the market falls, suddenly they stop. Array, whatever amount I had is already, everything is finished. So instead of that, in case you're slightly afraid, getting into the bond market, that will be much, much safer than you, I can compare to equity markets. So on that basis, definitely I can tell you that it is going to be definitely a long-term wealth creation for you, and is a stable income it can give you, stable return it can give you. For example, equity can go negative, it can give 20%, it can give 10% also. Here you can give a stable return of 10 to 11% on year-on basis, on a short basis. So now you have to decide how you want to allocate your portfolio. Thank you.
It's very interesting. I think it's all about portfolio diversification, as you rightly said,
Absolutely,
and
absolutely, yeah.
how you look at it as an addition to your portfolio where equity is there, but how does bond bring in that balance and stability to your portfolio, as you beautifully summed it up, sir. I'll move on to the last segment, which is our open forum audience Q&As. We have a couple of questions already in the chat box. I'll just start from the top where Mr. Raman has asked a question that what should a bond investor or a foreign investor look at while investing in bonds, whether high yielding bonds or high bond prices? I think Ramanji sir has answered that in the second question. So if there's anything that you would like to add to what you already said, we can, or we can move to the next question as well. Oh, lovely. So we'll move on to the next question. We have a question which says, how much liquidity infusion for the next few months would RBI do? Is there any limit to this if markets continue to go against the RBI? Sir, what are your thoughts on this?
The liquidity infusion has to be there. That RBI has never said that they want to control. Only problem is that if inflation is shooting up, they will be providing adequate liquidity. It is not that over liquidity they will be providing, but to manage advance tax outflow, GST outflows, etc. If the liquidity is not there, then short-term interest rates can shoot up. So on that basis, RBI may not be having comfort on those things. So they will be trying to provide enough liquidity to the system. On that basis, they can come with VRR, or they can go and do some bond purchase, something of that type, where prima facie they try to liquidate to get into providing some kind of a liquidity. But as I said, that if inflation is going to get increased, then the liquidity provision, they may be providing adequate liquidity the way the earlier governor used to do, Satyakanta Das, he used to do, provide adequate liquidity to control the inflation. So on those kind of things can come back.
Got it, sir. Very interesting. So Mr. Sanjay has asked two very interesting questions that I think will be very interesting for all our participants to hear your thoughts on this. That what will the implication of yield increase be on the treasury income of banks, especially for quarter 4, as banks will have to book MTM losses? Will it have significant impact on their overall profitability?
No, I don't think so, because I can tell you only one thing. Treasury income is only a portion of it. Other than that, most of the banks have made huge profits because the NPA got reduced and the returns are excellent. Growth is going very well. They're lending fantastically well. So already their profitability and every quarter on quarter, we see the profits are all fantastic. So this kind of a treasure, and already see, that's why I said bond market. People knows well before how the market is going to going to behave. So when they feel that market is going to go worse, they'll cut losses and get out immediately. They'll sit in light positions. So don't think that they'll be sitting till all the ways. They always they'll be either will be at MTM, or they'll be keeping it held to maturity, or they would have sold out everything already, whatever available for trading. So on that basis, even if they do some treasury losses for whatever positions they have, is not going to impact anything. Very, very marginal, I would say. Absolutely, there is no impact.
Good. And so Mr. Sanjay also asked a follow-up question on SDLs that you spoke about, that SDLs don't appear to be liquid, as you already mentioned. But are there certain maturities or SDLs that one can look at if they want to get into SDLs, especially for retail investors? Because on a 5 crore counter and above, whichever market lots, there is liquidity, but below that for smaller quantums, there is not. So how does a retail investor look at SDLs in this case?
And that's why I told you very, very clearly. You should know what you are getting into. Be very clear. So if you are getting into bonds or equity, for any marketable instrument, even in mutual funds, any marketable instrument per se, don't think that you'll always be able to exit. Exit means, of course, equity you can exit, and mutual funds you can exit. But at what level? If they're making profit or whatever amount you're invested, it's fine. But suppose you would have invested 2 months back and the pricing would have gone 20% below, will you be able to get out with a loss? That is your risk. Your principal goes. In bond market, your principal is protected, your capital is protected. Only problem where you are getting is that you may not be able to exit immediately. You may have to wait for the right buyer to come in. You need to be in close association with the people like OBPs or a broker or arranger, whoever you're talking to, financial advisor, whom are you talking to, they will find an alternative buyer. Till the time you have to wait. That is one thing. Second thing is that I always advise that you need to allocate your portfolio, you need to allocate your income, and you be very clear. Some income, for example 10% or 15% or income, where you feel that you don't require it immediately and you don't have to sell it immediately, only those type of money you should invest into treasury bills or long term. Otherwise, as I told you that, if you want money, if you want the principal to be returned on a, quarterly or monthly basis, get into short-term bonds of 18 months to 3 years, where you'll try to get your interest monthly and principal also monthly or quarterly. You can get most of the papers now have been offered in the A category. I think a lot of people are offering this kind of structures. So where your risk is also getting reduced and you're getting your money back also very quickly. So you have to plan. That's why I said bond market or bonds basically is just like a clay. You can mold it the way you want. That I already told you very, very clearly. So you need to find the structure, what kind of structure you need. You please go and ask your OBP or a arranger or a broker. You go and ask him, sir, I want this kind of an instrument. Do you have it? So if they have it, they'll give it to you. Otherwise, they'll source it and give it to you, or they will ask you to wait for some more time so that they can get the paper. That's it.
Got it. So I think you answered it so clearly that it depends on what tenor or what mindset that you're looking for the investment. Accordingly, you choose the kind of like bond, be it a SDL or be it a GSEC or be it a corporate bond for that matter. Thank you for your insight on that. The next question is from Mr. Sham, where he was talking about the certification that we shared of BondVue and asking that's NISM recognized. Mr. Sham, no, that's not NISM recognized. That is a self-certified course that we have developed with our panel of experts in-house. So that is only certified by BondVue. Uh, Venkat, so the next question is by Miss Ankita. Very interesting question. She says that as a retail investor into bonds, a majority of the bond options have monthly or quarterly interest payments. It's a good thing, but sometimes a reinvestment becomes a task. How do you suggest a retail investor can tackle this?
And that's what I said very clearly. If you are an experienced, bond market investor or a retail investor, you have been investing for at least for 2 to 3 years, then you can take a risk of investing into, 1 year interest payment, principal can be paid on the kind of redemptions, or you can go for this state government securities, SDLs. So you can decide on that. So basically, this kind of options I'm telling you is that where you are facing a risk. For example, I told you during the presentations also, discussions also, I told you that MSME is struggling because of the current problem for the past 1 month, and there could be some kind of a delay in payments or MFI, because there is some article I read in the newspapers also that MSME should be given some kind of exemption like the COVID period, or even MFIs can get into some issue, something of that type. They have to come out of it. So those kind of things is going to happen. So for that's why I said that for the first time investors, first you try your hand with the safety. For example, even if you're getting for a higher yield for a category, something of that type, you try with monthly redemptions and principal and interest redemptions and everything. And slowly, if you gain confidence, if you come to know more about good bonds and listed bonds, stable bonds, and good corporate issuing bonds, if you get an opportunity to get into, for example, a lot of public issues also coming in. So you need to check out what is good, what is not. I told you 4, 5 basis points with the discussion, what all things you have to look into 3 categories. You get into those 3 categories and see what all things you can do, what is the credit rating, how you can get into it. So accordingly, slowly get into long term. So see, that's why there is one more option is also available, is that zero coupon bond. Okay, zero coupon bond we call is a deep discount bond, or we call it as a zero coupon bond. Where the interest and principal all will be paid at the time of redemption only. So there is no coupon concept. There is a yield concept. So you'll get a yield, say around 9%. You'll be getting a yield of 9% at the time of reduction only, for which you have to buy the particular bond at a discount, generally at a discount. maybe I'd say around 80 rupees, let us assume. And at the time of redemption, you get 100 rupees. So the 20 rupees is your interest. Okay. But the problem where it is that there are two types of zero coupon bonds. One is the CBDT approved zero coupon bonds, where you have a capital gains benefit. Okay. So basically, it's like a accrued RD, bank RD. Let us be very, very simple about it. So bank RD, even though you're not getting the money accrued, you're not getting it. You're getting it at the end of the period, redemption period, but you are supposed to pay the taxes on the accrued interest. Same thing for zero coupon bond also. You're supposed to pay accrued interest, taxes on the accrued interest. But on the CBDT approved zero coupon bond, there is a capital gains on the end of these things. You have to pay only 12.5%. So, but more, except that is only available for government of India undertakings, okay, public sector undertakings. So AAA undertakings. वहाँ पे आपको yield will be very, very less. You may not be interested. It may be 6% or 7%, something like that. You may not be interested. There are some people, lower rated investors, who are issuing zero coupon bond for up to 3 years, etc., where you get a very, very attractive yield. But you should understand one thing, RBI itself is not very, very comfortable about that. RBI has clearly instructed in the circulars to banks and NBFCs that wherever, as an investor, if they want to invest in zero coupon bonds, the banks have to make sure that particular issuer is creating a sinking fund facility. That means whatever interest is accrued, they have to keep a separate bank account so that there is no credit risk. कल को company बंद हो गया है, so that at least the sinking fund facility say you will be able to get whatever amount is accrued in that particular deposits. If there is no sinking fund facilities, then if by chance, if the company goes into bust, so then the problem will be you may not be able to get anything. आपको principal भी चला गया, interest भी चला गया बोल के चिंता होगा. So nowadays, those things, generally you need to, that's why I said that you need to find out, what you are entering into. You need to be very clear what is the credit rating and, how the issuer has been there, uska credit record kaisa hai, uska profitability kaisa, everything you have to get into and doing it. So if you're able to see, and if you can get the help of your financial advisor or a bond portal, you can get into it very, very clearly on those things also. But you need to understand zero coupon bond is more risky than a regular coupon bond. Be very clear on that.
Got it, sir. So it's very interesting perspective again. Just in the paucity of time, we'll take 2 to 3 more questions that we already have. Mr. Sarvesh asked a very interesting question. He says that of late, credit rating has become very questionable. Like most recently, we saw this with DHFL and a couple of other incidences. So how can a retail investor sift through the junk and choose the right corporate bonds to invest in, given the credibility of credit ratings as well today?
See, you cannot simply go and say the credit rating, it's bad. Okay. So I won't agree with that. So yes, there has been some instances which has happened, definitely. But it is not only because credit rating agencies evaluate the credit rating based on the information available to us, available to them, basically. Okay. So if the issuer provides all the records, balance sheet, and everything, so basically they see the profitability and everything, then they evaluate. In case of any misinformation reported, or in case of any fraud for any company, I'm not talking about the names you have mentioned, but generally I don't talk about the companies. For any company, for say, I'm telling that any problem happens, or a startup company where there is no proper information, etc., then it is going to be a difficult thing for even a rating agency. That's why I always tell people that whenever you invest, you need to invest in curated bonds. So that's where your online bond portal or your financial advisor or a broker comes into picture. So you need to request these people, boss, please give me this bond. Is whether curated. Did you check these bonds properly? Did you read the analysis? Did you have done any analysis on the particular instrument? As I told you that credit rating is an important factors there. They'll tell you the weakness and strength, and you yourself will know that how for the profitability is there, and whether the promoter has been in the industry for a very long, whether he has the knowledge, and whether the particular industry what you are getting into, that industry is doing very well or not. This is very, very critical, because if the particular industry is not doing well, definitely the company is not going to do very well. It is irrespective of the company, how big the company. The particular industry itself is not going well is going to be a problem for you. So you need to check the industry also. So industry, promoter, profitability, credit rating, all these things you need to check into it. So other than that, otherwise it'll be very, very difficult. You can ask the how can the retail investors go and check. You can these are all basic points. You can just see promoter. If you go and see the credit rating report, everything is mentioned there. Okay, or the IM, everything is mentioned there. These are all. That's why I said that listed documents. You have to go for only listed bonds. That is why I'm again telling. Listed bonds, they have to submit to stock exchanges. These are all there. You can read the document, at least the basic term sheet, for what purpose they are buying. So these are all things you should know how they are going to repay. So these are all things will be mentioned there. So how are the profitability? Whether the rating has come down over a period or rating has been consistently going up over the period. These are all things that's going to help you. And that's how you have to decide. So basically, you have to get into curated bonds. Simple.
Yes. Absolutely. So as you rightly mentioned, I think as retail investors, we need to go deeper before making the investment, not just rely on the credit rating agency, see the financial, see the industry, see the promoter, see the rating timeline, what has been upgrades or downgrades, etc., and all of that is available on the IM. So we have to make that study by ourselves before actually jumping in and just relying on the credit rating agency. So just last question we'd like to take. A lot of people have asked Mr. Mukund, Mr. Gagan, etc. That so what is your perspective on the current yield differential between the Indian GSEC 10-year and the US 10-year? Any specific implications on domestic currency bond markets? And given the war situation, is this a good time to subscribe to bonds, government or good corporate bonds from retail investors?
Sir, I told you very clearly, if you see US is somewhere around 440 or 450, even, Australian 10-year is also almost touching 5, and Japanese also is about to 10-year. So everything is on the higher side only. It's globally, the yields are high, irrespective of it is a developed economy or emerging economy. So on that basis, definitely, till the time market settle is going to be worse only, especially not for India per se. It's going to be for the global developed economies. India is far, far better, I can tell you. So that is one thing, be very clear. इंडिया में अभी तक इतना टेंशन होने का जरूरत नहीं है. So that is number one. Number two is that already you are getting a fantastic yield. Okay. So if you want to get into actual reality, okay, immediate investments, state government securities, offering a very good yield. Even you can go through RBI Retail Direct. Number one, number two, you can get into GSEC. The yields are going up further, but GSEC is almost equivalent to FD level. So not even though it is very sovereign, there is no problem. Not many people will be interested. But going forward, when April comes in, a lot of people will come to the market. They have to offer higher yield to you. So the yields are going to be attractive to you going forward. So definitely, our April RBI policy is going to be very critical, and what commentary they're going to give it. So even banks, I would say that I may not be surprised if the banks increase their FD rates also. So things are going to be very tough for them also. So on that basis, the going forward, the things are. I can only assure you that the rates are not going to come down. Bottom is definitely is not going to come down. It's going to be stable here. That's why I said, even the war stops here, yields can come down a bit overall for a triple A. Lower level ke liye, generally, it doesn't come down. It's stable on that same level only. But if the yields are started going up, automatically your yield also, at the lower rated bonds also, the yields started going up. So definitely next year is going to be, you have a lot of opportunities to invest. The opportunities for retail investors are already started, I would say.
That's very interesting. I think the bottom line is that, as you rightly said, the rates are not going to go down. It's going to be stable or there's going to be hike. So we look at it from that perspective and enter the market from that mindset. And with that, I would like to thank everybody for joining today's webinar. I know there are a lot more questions that people have. They've put it in the chat, but given the time, we will not be able to answer all your questions. But for that, we've also created a WhatsApp community called our BondVue Club. You can just scan the QR that's on your screen, or you can click on the link on the chat of your Zoom chat, and you be redirected to the BondVue Club. You can send in your questions over there, and we will definitely, sir, try to compile some of these questions, get it to you, and see how we can answer the investors who want to know more about markets or more about your thoughts on the markets in general. So thank you once again for taking out time on this Saturday evening and to learn about the bond market. So we're very grateful for your time. I know you have a very busy schedule, a lot of personal commitments as well, which I know about, and still you've managed to take out time towards the end of the financial year to enlighten all of us about the bond market and give us a lot of clarity. Like today, me myself as co-founder have learned so much from you and understood the bond market at a much deeper level, and I'm sure all our participants have. So any concluding thoughts or remarks from you?
Concluding remarks, I think I can tell you that this year has been uncomfortable, especially the last quarter, January to March quarter has been uncomfortable for many of the institutional bond market participants. But also, it is very important. People has got a lot of learnings how the bond market can turn into. So yields have moved higher, volatility have increased, but uncertainty still remains. What is going to happen tomorrow? Nobody knows. So these are all things is basically happens in bond markets too. However, this is also where the opportunities are created. So, for example, I told you about state government securities at 8% plus yields. Investors are getting a better entry points as far as state government securities are concerned. Okay, so nobody would have expected that state government securities can go up to 8% kind of a level also, or accordingly other bond products, corporate bonds also. So, in bonds, returns basically come from discipline and patience. So you need to invest patiently, cautiously. See, I told you the three categories, what you are getting into, what is the credit risk, and what kind of a tenor you are getting into. All these points you have to be very careful and accordingly decide and invest. So to conclude, this is what I want to advise. Thank you so much.
Lovely, sir. I think you've summed it up so well, given all of us clarity and a lot of confidence and a lot of enthusiasm with your energy as well, at how we look at the coming financial year and how we make the most of it. Thank you once again for all our participants to joining. Feel free to join our community, send in your questions, and so we will definitely try to get you back, given the amazing response you've had today, to answer so many more questions that people have in their minds. Thank you once again. Have a lovely
Thank
Saturday.
you so much. Thank you. Thank you. Bye bye. Take care. Thank you so much for the participants. Bye.